Have you ever seen a stock price clicked by and then your confirmation shows you paid a little bit more? Ever wonder what happened in that split second? Well, in the next few minutes, we're going to pull back the curtain on how your stock orders really work, and more importantly, how you can start to control those sneaky hidden costs. So let's set the scene. You're logged into your account, you're ready to make a move, you see the stock you've been watching, and right there on the screen, the price is a nice round 50 euros. Looks good, right? You decide to go for it. But then, boom, the trade confirmation email hits your inbox, and you see you actually paid 50 euros and 5 cents per share. Now, I know what you're thinking. 5 cents isn't a big deal, but multiply that by 100 shares and then by all the trades you'll make in a year, and trust me, it really starts to add up. So where did that extra money go? It didn't just disappear into thin air. It's actually a key part of the market's inner workings. And understanding this little mystery is what separates a casual trader from a truly informed investor. Okay, so here's the thing. Every single time you go to place an order, you are making a choice, even if you don't realize it. It's this fundamental trade-off between getting your trade done right now versus getting it done at the perfect price you want. And that choice brings us to the two main players on the field, market orders and limit orders. Just think of them as two completely different strategies. One is all about the need for speed, just getting it done. The other is all about having complete and total control over the price you pay. A market order is basically you shouting, "Get me this stock right now. I don't care about the exact price, just get me in." It's kind of like trying to buy a last-minute concert ticket right at the gate. You'll pay whatever the going rate is just to get through the door. You're guaranteed to get in, but you've given up all your power over the price. Now, a limit order is the total opposite. It says, look, I am only willing to buy at this price or lower. Or, if you're selling, I'll only sell at this price or higher. This is more like placing a bid on an auction site. You name your price. You get total control, but there's absolutely no guarantee your order will actually go through. You might just miss out entirely. And this is a big one. This trips up so many people starting out. You might see the stock price on the screen hit your exact limit price, and you're thinking, great, it filled. But then nothing happens. Why? Because the market is a giant orderly queue. It runs on what's called price time priority. The best price gets to go first, sure, but for everyone at the same price, it's first come, first served. Someone else was in line ahead of you. So where does all this action actually take place? It happens inside something called the order book. You can think of it as the market's main arena. It's this live, constantly changing battlefield where all the buyers and sellers meet to duke it out. Inside this order book, you'll see all the buy orders, which are called bids, and on the other side, all the sell orders called asks. And that tiny little gap between the highest bid and the lowest ask, that's the bid-ask spread. And that spread is essentially the cost you pay for the convenience of being able to trade right this second. And let's clear up a huge misconception right here. The spread is not a fee that your broker just pockets. Not at all. It's actually how the market pays the specialists, the market makers, who take on the risk of being there 24/7, always ready to buy or sell, which guarantees that you can always find someone to trade with. They provide the liquidity. The order book also shows us something called market depth, which is just a fancy way of saying how many shares are up for grabs at all the different price points. So if you want to buy 100 shares and there are 5,000 available at that best price, you're golden. But what happens if your order is bigger than the amount of shares available? This is where it all comes together. This is where we get to the real nitty-gritty all-in cost of your trade. And I'm telling you, it's almost always way more than that little commission fee you see on your statement. So let's say you want to buy 1,000 shares, but at the best price, 30 euros, there are only 500 shares for sale. Well, your order is going to instantly snap up those 500 shares. But what about the other 500? Your order immediately jumps to the next best price level, which might be, say, 30 euros and 12 cents to get the rest. That effect, where your own order pushes the price away from you, is called market impact. So, because you bought shares at two different prices, your true average price isn't 30 euros anymore. It's what we call the volume-weighted average price, or VWAP. In our little example here, it comes out to 30 euros and 6 cents. That extra 6 cents per share, that's a real cost that came directly from your own market impact. Now, the pros, they use a metric to measure all of this called implementation shortfall. It sounds complicated, but it's really just the most honest way to look at your trading costs. It captures everything, the market impact we just talked about, plus any commissions. It's the true difference between the price when you first had the idea to trade and what you ultimately ended up with. All right, let's put a bow on this example. The The total cost for that trade was 70 euros. But here's the absolute kicker, the thing I really want you to see. Only 10 euros of that was the visible, obvious commission fee. The other 60 euros was that invisible cost from your market impact. Think about that. The hidden cost was 6 times larger than the fee you actually saw. Okay, so you get it now. But what do you do with this information? How do you put this into practice? Well, let's build a super simple pre-trade checklist so you can start trading smarter. From now on, before you even think about clicking that buy or sell button, just ask yourself 3 quick questions. 1, how's the liquidity looking? Is that bid-ask spread tight? Is there enough depth for the size of my order? 2, what's my real priority here? Do I absolutely need to get this trade done now, meaning a market order is okay? Or is controlling the price more important, so I should use a limit order? And 3, what time is it? Spreads are almost always wider, and things are crazier right at the market open and close. Maybe wait a bit. By understanding this whole journey your order takes, from your first choice of order type to the fight inside the order book, all the way to the final true cost, you're no longer just along for the ride. You're in the driver's seat. So now that you can see these hidden costs, are you ready to start controlling them?